Most people imagine financial change as something loud, a crisis, a crash, a moment so dramatic that it forces everyone to pay attention. But the most important shifts in global finance rarely look like that. And when those systems change, they don't just affect governments or central banks. They shape how trade is priced, how currencies behave, how stable markets feel, and how economic power is exercised over time, including the system your savings, business, and cost of living ultimately depend on. Over the past few years, a group of countries not usually viewed as a single force has begun to alter the plumbing of the global financial system, not by tearing it down, not by challenging the dollar directly, but by slowly reducing their dependence on it. This is where BRICS enters the story. When BRICS appears in headlines, it's often framed in extremes: a new reserve currency, an alternative to the IMF, or the end of dollar dominance. Most of that misses what actually matters, because what's happening isn't dramatic, and it isn't immediate. It's structural. BRICS is not trying to replace the existing system overnight. It's trying to make that system optional. That distinction is critical. Systems don't usually fail because they're attacked head-on. They weaken when participants quietly build ways around them. When enough trade, reserves, and settlements no longer depend on the same central rails, power begins to diffuse. Markets are excellent at reacting to shocks. They are far less capable of pricing slow erosion. How the current system actually works. The modern global financial system wasn't designed in a single meeting. It evolved through decades of trade, war, reconstruction, and compromise. At its core is a simple arrangement. Most global trade is priced and settled in dollars. Central banks hold dollars and U.S. Treasury bonds as reserves, and international payments move through institutions and networks tied to Western legal systems. This structure created enormous efficiency. It reduced currency risk, increased liquidity, and allowed capital to move at scale. For decades, it worked remarkably well. But efficiency also created dependence. Because trade is settled in dollars, countries need dollars. To get them, they export goods, sell assets, or borrow. Those dollars are then recycled into U.S. government debt, reinforcing the system. The bond market becomes not just a funding tool, but a pillar of global liquidity. This is where power enters the picture. Control over settlement, clearing, and access to liquidity gives the system an enforcement mechanism. Rules are not imposed equally. They are applied through access. When relations are stable, this arrangement feels invisible. When relations break down, it becomes very visible, very quickly. Sanctions, asset freezes, and payment restrictions are not anomalies. They are features of a system built around centralized trust. None of this makes the system evil or broken. It makes it conditional. And that conditionality is what large, trade-dependent countries are now trying to manage. To understand BRICS, you have to see it not as a rebellion, but as a response to this structure. This context matters because any attempt to change the system has to work within these constraints. You don't exit a dominant settlement network instantly. You reduce exposure gradually by adjusting incentives, reserves, and trade practices while avoiding open confrontation. That slow approach explains both the patience and the ambiguity surrounding BRICS initiatives and why their significance is easy to underestimate in real time, especially for markets trained to react to events, not structural shifts that unfold slowly across balance sheets and institutions. What BRICS is actually building. When people ask what BRICS is building, they usually imagine a single grand alternative. A new currency, a new central bank, a parallel IMF. That framing is misleading. What's actually emerging is a collection of smaller, interoperable mechanisms designed to reduce reliance on existing financial choke points. The first mechanism is local currency trade settlement. Instead of pricing every transaction in dollars, two countries agree to settle directly in their own currencies. This doesn't eliminate exchange risk, but it shifts where that risk is managed. Over time, it reduces the need to hold large dollar balances just to conduct trade. The second mechanism involves payment infrastructure. Alternative messaging systems, regional clearing arrangements, and bilateral settlement lines allow transactions to move without passing through the same centralized networks. These systems don't need to be global to be useful. They only need to work for specific trade corridors. Third is development and liquidity support. Institutions like regional development banks provide funding outside traditional Western channels. The goal isn't to replace global markets, but to create fallback options when access is constrained. Finally, there's the role of commodities. Some BRICS members are major exporters of energy and raw materials. Pricing and settling portions of that trade in non-dollar terms changes the demand profile for currencies and reserves at the margin. None of these mechanisms are revolutionary on their own, but together they create redundancy. And redundancy is the real objective. A system with options is harder to pressure than one with a single point of failure. Step by step, these tools change behavior. Firms don't need as many dollars on hand. Central banks diversify incrementally. Trade agreements are written with flexibility instead of standard templates. None of this requires trust in a new hegemon. It only requires trust in bilateral counterparties and contracts. That lower trust threshold is critical. It explains why adoption can happen quietly, unevenly, and without coordination. Countries participate where it benefits them and ignore the rest. This modular design is intentional. It avoids forcing alignment, reduces political risk, and allows the system to grow organically as conditions demand. Over time, these marginal choices accumulate into structural change, even if no single decision looks transformative. That is the logic behind what BRICS is building and why it matters systemically globally. Evidence that this is already happening. All of this would be academic if it weren't showing up in real data. But over the past decade, there have been measurable shifts that point in the same direction. Trade settlement in non-dollar currencies has increased between certain country pairs, especially in energy and regional trade. These are not headline numbers, and they don't dominate global volumes. But they persist, and they tend to expand after periods of financial stress. Central banks have also adjusted their behavior. Dollar reserves still dominate, but their share has gradually declined. At the same time, gold holdings have risen, particularly among countries that are more exposed to geopolitical risk. This isn't about return. It's about neutrality and control. Payment behavior offers another signal. When sanctions or restrictions are imposed, affected countries accelerate the development and use of alternative channels. Once built, those channels rarely disappear. They remain as insurance. None of these trends prove that a new system is imminent, but they do confirm intent. They show that governments are preparing for a world where access to the existing system cannot be assumed. Importantly, this is not a coordinated march. Adoption is uneven, cautious, and often reversible. But direction matters more than speed in structural shifts. History suggests that financial behavior changes first at the margins. Large systems don't flip all at once. They thin out. Liquidity fragments. Preferences diversify. These signals are easy to dismiss individually. Together, they form a pattern of risk management rather than rebellion. That distinction helps explain why markets have largely shrugged, even as the groundwork quietly expands. Nothing here requires belief in a new order. It only requires recognizing that governments adapt when incentives change. And those incentives have been shifting steadily, shaped by sanctions, debt levels, and political fragmentation. This is the validation layer. It shows the blueprint is already being implemented, quietly, and it sets the stage for understanding the broader consequences if these trends continue over the next phase of the global system evolution. Scale, compounding, and systemic consequences. If these changes remain small, their impact is limited. But systems don't respond to single data points. They respond to accumulation. And that's where the long-term consequences begin to matter. As more trade settles outside the dollar, the demand for dollar liquidity grows more elastic. It doesn't disappear, it becomes optional in more situations. That subtle shift affects bond markets first. When reserves diversify, marginal demand for sovereign debt changes. Yields respond at the edges before they show up in headlines. For currencies, fragmentation increases volatility. Exchange rates reflect local conditions more directly when they're used for trade, not just speculation. That creates both opportunity and instability, depending on perspective. For equities, the effect is indirect. Companies exposed to global trade face higher hedging costs and more complex cash management. Firms operating within fragmented blocks may gain protection, while globally integrated models lose efficiency. Gold and other hard assets benefit from neutrality. They don't depend on payment rails or political alignment. That's why central banks accumulate them quietly, without fanfare. Crypto sits somewhere in between. It offers portability and settlement outside traditional systems, but it brings volatility and regulatory uncertainty. Its role remains conditional. The key consequence isn't collapse, it's complexity. A world with multiple financial rails is harder to manage, harder to stabilize, and harder to predict. Second-order effects emerge over time. Policymakers lose some leverage, but gain insulation. Liquidity pools shrink in one place and grow in others. Correlations that once held break down. For investors, this means fewer universal hedges and more regime-specific risks. Portfolios designed for a single dominant system may behave differently as fragmentation increases. The transition phase is usually the most unstable. Old assumptions fade before new ones are fully trusted. Pricing becomes noisier. Policy responses become less predictable. This doesn't imply imminent crisis. It implies a longer period of adjustment where risk management matters more than forecasts. And that adjustment reshapes how capital flows, how safety is defined, and how returns are generated across assets. Understanding that process is more useful than trying to time a dramatic breaking point. This is about regime change, not collapse narratives. And regimes rarely announce themselves when they begin. They become obvious only after incentives have already shifted and behavior has permanently adjusted across the system globally. Limits, risks, and internal contradictions. None of this means BRICS will succeed in building a coherent alternative. There are real limits and contradictions that matter. BRICS is not a unified bloc. Its members have different political systems, economic structures, and strategic priorities. Trust between governments is uneven, and trust in financial promises is even harder to build. Liquidity is another constraint. Global finance runs on deep, transparent markets. Replicating that depth takes time, credibility, and legal consistency. Without it, alternative systems remain supplements, not replacements. Fragmentation also has costs. Multiple rails increase friction. Hedging becomes more expensive. Smaller economies can be caught between systems rather than protected by them. And there is always the possibility of reversal. When conditions stabilize, some participants may return to familiar structures, especially if access improves. These weaknesses don't negate the trend. They define its speed and shape. They suggest a slow, partial transition rather than a clean break. Counter-arguments often focus on scale. The dollar is still dominant. U.S. markets are still the deepest. That is true. Dominance doesn't disappear quickly. But dominance and dependence are not the same thing. Reducing dependence can matter long before dominance fades. The vulnerability lies not in collapse, but in increased negotiation and uncertainty. That environment rewards flexibility and punishes rigidity, both for governments and for portfolios. This section exists to keep expectations realistic and grounded. BRICS is neither a silver bullet nor a sideshow. It is a constrained response to real incentives. And constrained responses often shape outcomes more than grand visions, because they align with how systems actually adapt slowly, unevenly, and under pressure, rather than through sudden ideological shifts. This is the risk profile that matters for long-term observers globally, what this means going forward. The most important takeaway is not that the global financial system is ending. It's that it is evolving in response to incentives that are already in motion. BRICS is part of that evolution, not as a replacement engine, but as a pressure valve. It reflects a world where optionality is becoming more valuable than dominance, and redundancy more valuable than efficiency. For investors, this doesn't demand panic or drastic action. It demands awareness. Watching infrastructure matters more than watching headlines. Settlement, reserves, and payment behavior change before prices do. The future system is likely to be more plural, more fragmented, and more politically conditioned. That means stability will look different. It will be managed, not guaranteed. Understanding these shifts early is not about predicting collapse. It's about adjusting expectations to a slower, quieter form of change that markets are still learning to price. In that sense, this is less a story about winners and losers and more about adaptation. Those who recognize structural shifts early tend to manage risk better than those waiting for confirmation. This is not about fear. It is about alignment with how systems change. And those changes, once underway, rarely reverse completely. They reshape behavior, policy, and capital flows over time, quietly, incrementally, and often without clear turning points. That is the environment forming now globally.